Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're working on your financial freedom. And when I say it's another edition of Tell Al Tuesday. We're going to talk with a fellow Lifestyles Unlimited member. This guy's name is Steve, and he's been on the show before. And I will tell you this about Steve. When he puts his mind to work focused on an objective, he achieves it. He achieves it very well. As a matter of fact, if you go back in time and you recall when Steve has been on the show before, you'll recall that he is a person that lives in Southern California. And he actually owned an investment property in California. Now, like most people that own property in California, the appreciation on this property got, it did very well. Let's just put it that way. That's kind of what happens in California. But the other problem that exists when you own property in California and the price keeps going up, and up, is you have a little thing called dead equity. Now, dead equity is not necessarily a bad thing. It just means you have wealth tied up in a particular property. But that was Steve's problem. He had wealth tied up in a particular problem. And what he realized was that if he could just get to that equity, if he could just extract that equity out of that one particular property, he could actually move that equity into additional pieces of real estate. And that's exactly what Steve did. He took advantage of something called a 1031 exchange, which allowed him to sell that property and move all of the taxable gains on that property into follow-on properties. What that did for him was it allowed him to keep all of his money at work. He didn't have to take some of the proceeds out and give it to Uncle Sam. Now, this is a completely legal strategy. It's built in to the Internal Revenue Code. So, what he's doing is absolutely legal, and it's absolutely smart. So you're probably thinking, all right, so he sold a house in Southern California. That's fine and dandy. What did that do for him? Well, it did some great things for him. Not only did he buy a fourplex, he also picked up another single-family property, and he's invested in 2 multifamily apartment communities, one in Indianapolis and another one in Atlanta. See, what you're starting to understand is that Steve, although he's a Californian by nature, as an investor, he is moving his money to places where it can be much more effective. So what we're going to do today is we're going to get Steve on the show and we're going to get into his mind. We want to understand what caused him to do all of this. So with no further ado, let me bring Steve onto the show. Steve, my friend from Southern California, San Diego of all places. How are you, my friend?
Hey, greetings from Southern California, San Diego. Really happy to be with you today.
I almost called you a native Californian, but I didn't do that because I wasn't 100% sure. So can you clear the record for me?
Well, I guess officially on the books, I am a native Californian. I was born here, but I didn't grow up here. So I came back here in my 20s, and I've been here ever since.
Okay, I think that qualifies as native Californian. So, California's a beautiful place. I lived there for a big portion of my life. San Diego, in my opinion, is probably one of the most beautiful cities on God's green earth. But your investment in San Diego was kind of problematic, wasn't it?
Yeah, as you become more of a seasoned real estate investor, you start seeing that California properties with rapid appreciation is not the best way to go. We have this concept of debt equity, which is the massive equity growth. And one of the main things that Lifestyles teaches us as investors is to use that money and invest it elsewhere where you can get significantly higher returns. And that's what I've been able to do this year.
So did you have any emotional or mental reservations to ridding yourself of that particular property? I mean, was there anything that was kind of tying you to this particular investment?
Well, it's interesting. The house that I sold that you mentioned at the beginning of the show that I did the 1031 was the original house that my wife and I purchased many years ago as our first starter home. And so you would think that we've had this for quite a while, and you would think definitely there's some emotional tie into it because it's where a couple of our kids were born. But we've rented this out for a very long time, and as my wife and I both grew in our investment knowledge, we looked at what do we really want to accomplish going into retirement, and we've been self-managing this property for many years, and we just decided, you know what, let's really focus on our retirement. Let's sell this place and let's move the equity elsewhere.
So where did you decide to move all this equity to? I mean, there's a lot of places in the United States that you could place your money. What did you finally decide?
Well, like many people in rapidly growing markets with the rapid equity buildup that we saw, we were looking at places that we could make a nice return on our investment, but get into multiple properties. So San Diego has appreciated an amazing amount this year, as has other markets. San Diego, in the middle of the summer, was at an annual appreciation rate of somewhere in the range of 24%, which is unbelievable. The rapid increase in this particular property was so high that I knew that I had to do something. So I started looking at other markets around the country. I knew I did not want to be in California because it's more of a cyclical market. You can have rapid rises and rapid falls of your value of your house, and some of the landlord-tenant laws are more and more unfriendly as the years go on. So I wanted to look at markets that were much more friendly toward landlords.
Yeah, that makes perfect sense to me, Steve. I'll tell you what, we come back from the break, we're going to get into this discussion even deeper, and we're going to ask the question, why didn't you just refinance? Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. All right, Steve, I got to ask this question because I know it's on the back of the minds of the people that are listening to us right now. Some people would think that you would have been better off to hold that property. I mean, tap into that equity, refinance it, do whatever you need to do, pull that money out and do with it what you will while still retaining that asset. But you chose to sell it. What was the thought process? Did you even think about refinancing, and if you did, why did it not win?
You know, the funny thing is I have actually refinanced this place a couple of times. But what I found in my learnings, and this was when I was early in lifestyles, and I did pull that out to make other investments. But what I found was the only way that I could make any kind of cash flow on this property in California is if I'd limit the amount that I'd finance out. If I would finance out the normal 80-20, 80% loan, I would have a significantly negative cash flow in California. And that was just not the direction I wanted to go. So, early on, as I was learning all of this, investment strategy, I didn't fully understand that. But, after a couple of refis, the direction I wanted to go was to just completely move out of the property. And then, as I mentioned before the break, I also was concerned about the direction that landlord-tenant laws were going in California. And I knew, because I've invested throughout the country now in the last 5-6 years, that I could make better returns elsewhere with my equity.
So you decided on a place in the Midwest called Kansas City. Why did Kansas City beat all the other locations out?
Yeah, isn't that interesting? A guy from San Diego picking Kansas City.
Yeah, trust me. There's a guy scratching his head right now, listening to us, going, "What is wrong with this guy?" Yeah, trust me, he's thinking it. Yeah.
well, so I started scouring different markets to see, okay, where could I find a landlord friendly market that would give me returns, and I also wanted to get into a market that was a little more affordable so that I could pick up multiple properties. But it still have plenty of room for equity growth. So I started looking around the country. Initially, since San Diego is just about a 6-hour drive from Phoenix, I started looking at there. And I was finding that what was going on in San Diego was also going on in Phoenix, that they had a 25% increase in house prices in Phoenix. And it was just a bidding war with everything I looked for there. So I also had looked in Dallas, kind of the same story in Dallas. I had some experience in Dallas before. Prices there are up 20%, and hard to find cash flowing properties when you get prices much higher with rapid appreciation. So I had before I joined Lifestyles, I had actually invested in a duplex in Kansas City many years ago. And, I decided to go back and look at that market, and I found a lot of good things in that market that made me decide to go back into that direction. One was the prices were much more affordable. So, I could get a house in Kansas City for probably about a third of the price of San Diego, for example. And and the appreciation was good. The rents were going up there. In this last year, Kansas City prices have gone up right around 18%, and the rents in the markets that I've chosen have been going up about 12%. So I just found some good indicators, and it was all because I had actually discovered this market several years earlier that I decided just to go back and give it another try.
Yeah, I think the Kansas City market is one of those little sleeper markets. People tend to overlook it. It's got a decent football team, but, our football team that we like is better than them. Not that we should consider football. But having said that, there's a lot of positive things going on in that Kansas City economy. I mean, it's almost, I don't know, correct me if I'm wrong, but does it feel like to you that it's kind of bulletproof when it comes to these massive swings in pricing as you've researched it?
Yeah, that was another thing that I really liked about Kansas City. It is not a cyclical market, so I call it a non-sexy market because it's just
I'd agree.
a steady upward trend. So whereas when we saw massive declines back in the housing crash, we don't see those same type of declines in these linear markets. So markets like California, which is much more cyclical, it's going to go up massively. But when we have declines, it goes down rapidly, and that's one of the reasons that I wanted to take my equity during a really high point and put it into a linear market like Kansas City, where I just see a nice, gentle, slow growth. And so that was another big indicator for me that Kansas City looked like a good area for me to invest in.
So how are the returns doing for you? I mean, if we compare the old property in San Diego and what it was doing for cash flow and returns for you, and we compare that to the fourplex and the single family house and the 2 additional investments in multifamily, how's everything shaken out?
Well, the returns, because I had so much debt equity in the San Diego house, the returns were very small. So I knew wherever I went, I was going to get significantly higher cash flow. So I am still fixing up a couple of my units in the replacement properties that I purchased in Kansas City, but I expect by early next year that my returns should be in the range of at least 3 to 4 times the amount I was getting in San Diego in terms of cash flow. And,
okay.
Another thing that I've liked is looking at the appreciation. So Kansas City, the prediction by the experts, and there's many experts out there, but the range that I have seen is that Kansas City prices will continue to rise after last year's 17 to 18% increase. They're expected to rise in 2022 by 9 to 13%. And one of the things that I've seen, just looking out on the internet, just looking at estimated prices, and of course sites like Zillow and Trulia, you have to take that with a grain of salt, but it kind of gives me an indicator of trends, which direction the prices are going. And so I'm seeing, based on the trends, that one of my properties that I purchased has already increased in the range of 4 to 6% just since I purchased it in July.
Wow. That's pretty remarkable, actually. I think that's indicative of what's going on across the nation. But it's kind of interesting that a market that you described as linear is actually taking advantage of some of this cyclic growth. I mean, that's got to excite you, Steve. I mean, I know it excites me. And I'll tell you what, when we come back from the break, we're going to find out how Steve paid $0. You heard me correctly. $0 in taxes. Maybe he knows Al Capone. I don't know. I'll ask him that when we come back. Stick around.
Warning. Listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. So let's kind of give you a recap of what's going on today. First of all, I have Steve on the show. Steve is a native Californian, was born there, not necessarily raised there, but he went back and he's lived most of his adult life there. And he even invested in property in San Diego. But when he became a member of Lifestyles Unlimited, he started looking at that property that he had in San Diego, and he realized that he was wrestling with a little monster called debt equity. And even though he was able to refinance the property and take some of the money out and put it into other investments, he was always kind of capped on how much equity he could tap into, because if he went too high, he would all of a sudden create a negative cash flow situation for him, meaning he would have to pay out of his pocket every month to maintain that property, which is not a smart way to invest. Now, ironically, when Steve pulled the trigger and decided to sell that property, he did something called a 1031 exchange, and he was able to move all the proceeds tax-free into follow-on properties. And here's part of the result. His cash flow has increased by like 3 to 4 times, meaning if he was making, let's say, $1,000 a month on the San Diego property, he's making $3,000 to $4,000 a month just by trading out the assets. This is one of the reasons you have to take a look at what your assets are doing, and you have to make an informed decision as to whether or not you can do better somewhere else. And clearly, Steve figured out that he could do better somewhere else. So Steve, I mean, I read your note here, and I'm sorry I outed you to the government, but I know you didn't want me to tell the politicians that you had a zero tax bill, but how did you pull all this off?
Well, I know you've shared this on your show many times, but real estate is the most tax-friendly investment, and the reason behind it is the government understands what an important part of the economy that the housing part of the economy is, and so by providing affordable housing, we provide an incredible amount of increases to what the economy produces over time. We provide jobs, et cetera. So one piece of that code is the 1031 exchange, and this is used primarily by by a lot of people, smaller investors like myself, that it really not only stimulates the economy, but also helps to grow their own net worth and allows them to give back in the future to their family. And so the 1031 exchange is what I decided to use. This allows me to take the equity that I had earned in the San Diego property, take all that out, and roll it into equivalent properties in the market that I choose, and I chose Kansas City. And by doing that, and by using a 1031 exchange, I was not required to pay taxes on the gains that I made in San Diego, which were significant, obviously, in a rapidly appreciating market.
So I know when I did my 1031 exchange, part of what I did is I sat down and I looked at, okay, if I were to pay the taxes on this, one of the things I figured out real quick, because I had owned these properties for so long, about 70% of the gain would have gone to taxes. But by doing that 1031 exchange, I kept that 70% in the deal. What kind of number were you looking at? I mean, if you were not going to do the 1031, where were you looking as far as a percentage that would go to the government?
Well, I'll tell you, Al, it would have been more than my annual salary because of the rapid increase. So it was significant. So
it was a big chunk. I mean,
it was a big chunk of extra taxes that would have gone there. So I really had to decide as we're hoping to retire in the next few years. Is there a way that I can do something much more tax friendly way with this property? And that's how I started digging really deep into the 1031.
If you wound up having to pay those taxes, I mean, what deals would have come off the table? Would you have been in both of those multifamily deals, or would they have been a bridge too far?
I probably would have gotten into half of the deals that I could have gotten into.
Okay.
Because I would have probably taken half that money and sent it to the government.
Which would have delayed your game plan of getting yourself fully retired in the next 2 to 3 years. That's right. So this 1031 exchange really worked well for you because it allowed you not only to reposition your money into different assets that are doing better for you, it kept you on track, might even accelerated your ability to get to that retirement goal that you've set for yourself.
Yeah, it absolutely did, and because of this, I was able to purchase. I ended up putting a down payment on a fourplex in Kansas City, and then I was able to buy another house with cash, and that was a single family home. So that was 5 units right there. So you may ask, well, if you buy the house with cash, isn't that just debt equity again? And yes, it is. But my strategy went beyond that. So after I closed on that house, then I started looking at, okay, now how can I use the debt equity on this house? And that's where I pulled money out and did the refinance that you were talking about earlier. So I did a refinance and did it very, very conservatively so that I'd keep strong cash flow on this single family house. And then I took that equity and I rolled it into two multifamily investments, one in Atlanta and one in Indianapolis.
Man, I love how this it just keeps unfolding. It's like, did you ever play pinball when you were a kid?
Oh yeah, yep. Pinball wizard, right?
Yeah, me too, man. And I'll tell you, it's like you're playing the pinball and you think you're going to lose the ball, but something happens and you save it, and all of a sudden the game is still alive. Well, that's kind of what I'm seeing with what you're doing with the real estate, because it allowed you to take that money out of the debt equity asset, buy a property. Yeah, you pay it all cash, because that's one of the things that you have to take into consideration is that you have to migrate the money over, and maybe it's better to pay all cash for an asset just to satisfy the 1031. But now you've got your conventional lenders that are waiting in the wings that know exactly how to extract that money for you, and as long as the number's right for you, you take the money out, and now you're doing great things with it. You haven't violated anything, but now you've got so many more assets working hard for you. I mean, this is like a home run, Steve.
Yeah, it's a total home run. And, going back to the refinance, what if I would have just refinanced that San Diego property? Well, I would have had a negative cash flow then on the San Diego property. And yes, I would have rolled it into other investments, but my goal was always to have a positive cash flow on every single property I have. And so by rolling the money into Kansas City, buying one with cash, doing cash out refi from that one, then that property is cash flowing. My fourplex is also cash flowing really nicely. And now I will have 2 properties next year, and those will cash flow strongly next year as well. So it's just a complete home run for our family.
Man, I'll tell you. So let me go back to the single family house. Now, was this a typical Lifestyles house? In other words, you looked at it and it was kind of ugly, and might have been missing some windows or things like that, or did you go out and find something that was ready to go?
So a mixture. So the fourplex was exactly the way you described it. It was ugly. It was probably the ugliest one on the street. But it also was the best location on the street in a really nice neighborhood. So that one I am definitely investing in and doing some rehabs on it, and the rents on that are going to be raised significantly because the owners that I purchased it from did not know how to manage property.
Oh, I love hearing those words, man. I love hearing the other guy didn't know exactly what he was doing. Oh, maybe he should have been a member of Lifestyles Unlimited. We come back from the break. We're going to get back into Steve's mind. There's a lot for you to learn. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. Man, I'll tell you, Steve is working on that lifestyle. I mean, his primary goal right now is to achieve full retirement. In other words, have enough passive income coming in from all of his real estate investments that he regains control of his life, that he's able to step away from the job that he's doing right now. And I got to ask you, Steve, I mean, are you enjoying the work that you do, or are you just like counting the days? Where's your head at?
So I'm in the high-tech industry, software architecture, and I really do enjoy the job that I'm doing. I want to continue working for several more years because I enjoy having the capacity to invest in more real estate by having my job. But eventually I will, take the passive income that I've earned from all my investments and just retire comfortably with my wife, who has already retired, by the way. We've already retired her through our passive income.
Man, I love that. I love hearing those words. So you're 50% of the way done. We just got to get you there, and you're already on track for doing it. But I want to go back to this fourplex, man. I mean, I'm just enamored by the fact that you went out and found the nastiest property in the neighborhood, but on the best lot in the street. So when you took this thing over, obviously you mentioned that the previous owner just wasn't very good at owning and operating the property, and that you probably saw this is a great opportunity for me to fix those things. So what did you do specifically when you took over the property? I mean, did you have to throw everybody out? What was going on with that property?
Well, we're still in the process. So it's in that first year of getting it running smoothly. But when I purchased the property, the owner, I looked at the rents, and the owner was charging on the there's 2 3-bedroom units and 2 2-bedroom units. He was charging close to $500 below market rents on the 3 bedrooms. Wow. And probably close to $300 below market on the 2 bedrooms. And because of that, because he didn't have any income coming in, he wasn't able to maintain the property appropriately. So the property was very tired. And one of the units was empty when I purchased it, and it had been trashed by a very, very tough tenant that had been evicted before I purchased the place. So it was in very tough shape. So we've been focusing on that, and we're just about to rent that one out. We're putting it on the market right now, but we actually are expecting to go up about $600 per month in rent because it was so mismanaged. It was in such rough shape, and now it's basically been upgraded to a new unit that's the nicest on the street.
Wow. Holy smokes. $600 rent bump. And you didn't do anything to create that. You just looked at what the market was bearing, and you just produced a unit that met that quality level. And you're going to find people that are willing to pay you your price point because it's a great place to live.
That's it, exactly. So we always want to have the best price, best place to live. And so, they're going to, we believe our tenants will walk into the house, or the prospective tenants will walk into the house, and it'll be a place that they just look at it and say, this is where I want to live. And yes, I feel the value is really good for the market. And, it's completely opposite from the way that the previous owner was managing it, because obviously he hadn't been trained through an organization like Lifestyles Unlimited.
Yeah, it sounds like it, but which, just translates into opportunity for you. So I'm all on board with that. The other 3 units, now, these are residents that you inherited. I mean, are they paying on time? What's going on with these folks?
Well, I did have to send one tenant on his way. The previous owner also had not required any deposits. He had not been renewing leases, so they were on a month-to-month. The other 3-bedroom unit was another problem tenant. The 2 middle ones were fantastic tenants, both paying on time, and so both of them are staying. We did raise their rents, but I wanted to keep them, so I didn't raise it, drastically. But I did definitely raise their rent, put them on a 1-year lease with required deposits. So we structured it so that it was, professionally managed, and a place that they knew that they were going to be getting value over time. And so they both saw the changes going on in the property, and they both wanted to stay because they were happy about some of the things they saw that we were doing with the other units.
So what kind of feedback did you get from these residents regarding the previous owner and what he did or failed to do? I mean, what kind of chatter were you hearing? Well, the positive feedback, it was kind of a mixture. So one of the tenants said, we knew when a new owner took over that they would need to raise the rents because things weren't being maintained around here. And so, obviously they were disappointed that they were getting rent increases, but they signed immediately because they saw things that we were doing. And, they know that only positive things are ahead from them compared to what was going on with the previous owner. And so they quickly signed, and we also were very kind to them in terms of the deposits required. We just structured it so that they would get their deposit paid over a period of 6 months, so that after 6 months they would have a full deposit on board with us. So they were very appreciative of that, and so they could see that they were going to work with somebody that cared about how they lived and wanted to improve their life. Yeah, you just blew up a stereotype of landlords right there and then. You just did that, right?
Well, that's kind of our motto. We always want it to be best price and the best product on the market. So that's what we do with lifestyles types of investments. That's what all of us owners strive for.
Well, and what I think is beautiful is that you had 2 families that were living on the property. They liked living there. They saw the potential. They were thankful that somebody like you would come in and acquire the property, because obviously you're fixing a lot of the problems that they had to endure. They may be getting a price break on the rent, but ironically, they were getting what they were paying for. And I think they're smart enough to realize that if they bump their price point up, they're going to have a much better living experience. And I'm guessing that's exactly what they're experiencing. What are your thoughts?
Oh, absolutely. Just one example. One of the units actually had roaches, and they were just living with it. They weren't seeing any action. First thing we did in there on day one was we got someone to go in there and start taking care of that problem. They also were living with items in the unit that any landlord should fix immediately. They were just kind of used to it, just living with it. And once they saw that we were going to come in and fix some of these things that were really pretty cheap to fix, that should have been done, years ago, they were really excited. And I think that's part of the reason they signed the new leases right away, because they wanted to stay in a place that they saw that was going to be properly maintained.
What are you thinking about hold times for these properties? You're going to hold them for a year, 5 years? What's the game plan?
Well, with the fourplex, I'm going to hold a little bit longer. It's a multi-unit property, and so I'll probably keep that, in the 5 to 7 year range, something like that. The single family home is a stepping stone to something bigger. So we're not sure if we're going to do a small apartment after that, and we'll do another 1031 at that point, or if we want to do another fourplex. We're still trying to decide. I do have a son that is very interested in real estate. He actually has been helping me analyze these Kansas City properties, and so we may do something together, he and I, in a bigger property. And so I would say the whole time for this single family home, maybe 3 to 4 years, and then we'll roll it into something bigger. But the fourplex will keep for a little bit longer.
I'll tell you, and I know these aren't the only properties that you have and the only investments you have. And I'd say, Steve, you are doing exactly what you need to do, because I've known you for a while. I've had the opportunity to understand your story. I've had the opportunity to watch your journey. And I'll tell you what, man, you're a textbook example of doing the right things the right way. So I'm just going to say that on the air in front of everybody, because that's the quality of investor that you are, my friend.
Well, I appreciate that, Al. And you did mention other properties. Our main strategy is the multifamily passive, where we invest with other investors in larger multifamily apartment buildings, and we have invested in those all around the country, and those are just so easy to invest in. The single family homes and the fourplex, I like to do those too, because they pull out my creative side, and it's just kind of fun to see the direct changes that you're making in both your tenants' lives and the neighborhood in general. So this gives me a little more hands-on. But as a full-time worker still, I mostly am doing things that are more on the passive side, and I really enjoy just getting that money coming in that helps support my family every quarter.
I totally get it, Steve. Hey, we're at the end of the show, and I want to thank you for coming on. And for those of you wanting to get started, go to lifestylesunlimitedworkshops.com.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.